Back now is MassMutual CEO Roger Crandall. Roger, thanks for being back with us. So here's the setup, I think. I mean, the equity risk premium is at a 20-year low. That's the difference between the earnings yield and the yield on government bonds. The S&P at its highest level in a year and a half, roughly, and yet a whole generation of investors doesn't believe in holding a significant position in bonds anymore. What should they do?
Well, thank you for having me, and nice to see you again, John. Yeah, look, when we were together in March, there was real concerns about what was going on in the banking system, and I think I just made the simple comment: it's hard to have a recession when most Americans who want a job can find a job, and frankly, that has continued. You know, I think for individual investors right now, equities have done great. They're up over 14% since we were together in March. I think you really always need to be looking at your asset allocation. And for the first time in a long time, you actually get paid to be a saver. You know, you can earn 4.5%, 5% in short-term, very low-risk treasury bills. Money market funds have a nice yield. I think it's more important than ever for people to make sure they have their asset allocations aligned with what they're trying to achieve. They're working with their financial advisors to do that. You know, after periods like this, a little good old-fashioned rebalancing is never a bad idea, in my opinion.
What impact are you expecting from student loans kicking back in, those payments coming through? And then, yes, inflation growth, now that growth is slowing, but costs are still so high for consumers. And we're heading into the back half of the year when spending on products is a lot of what we expect in the economy.
Yeah, you know, so when I talk to the MassMutual advisors and what their clients are thinking, they are very aware of inflation. And I think you made it. Although rates are down, they're still too high, and the Fed has told us that. The Fed has said they're going to be data dependent. They're going to continue to raise short rates if they need to make sure that the inflation monster is slain, so to speak. I think there are some things to be worried about. First is, remember, the lags of monetary policy were famously described as long and variable. And this tightening cycle only really kicked off in March of 22, and the Fed has continued to raise. In fact, they've raised 3 times since I talked with you in March. So the full impact of this running through the economy, you're seeing just today there was a report out on loan officer survey that the Fed puts out, and banks are tightening credit without question. Higher rates are still working their way through corporate balance sheets. So you're seeing levered companies have to pay a lot more in interest expense. And these are all things you would expect to slow the economy. And you mentioned an awful lot of folks who haven't had to make a payment on a student loan are going to have to make those payments, and you'd expect that to impact as well. So I think, you know, caution is warranted here because of these pieces. We've also seen, unfortunately, a little bit of an uptick in commodity prices recently. Oil's back up, gas up a little bit. The war in Ukraine terribly rages on with the grain deal off. We're coming into the winter again in Europe. We had a very easy winter last year from a weather perspective. China weak. So I think there's still plenty of warning signs kind of out there as we look ahead for sure.